Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Kevin Davitt, head of index options content at Nasdaq, as well as Eric Metz, chief investment officer with SpiderRock Advisors. And we're here to discuss how investors and institutions are reacting to and managing the volatility backdrop in 2025. It's great to see the both of you, as always. Eric, your firm, SpiderRock Advisors, you work with individuals and institutions to manage risk. It's been an unusual first 6 months in the market. Trade wars, tariffs, continued unrest in the Middle East, and the list goes on with the market climbing a wall of worry here. How are you and your clients reacting to the volatility backdrop year to date? Because if you look at the S&P, it's up about 2% for the year, but from January until now, the action certainly suggests something else.
It's amazing, isn't it, Jill? It's like the start to finish, close your eyes on January 1st, wake up today. It looks as almost not a whole lot has happened. And to the contrary, a lot has happened. I think at the end of the day, markets are volatile. They have been volatile. They will continue to be volatile. And the forces that are causing that volatility are always many. But I think, a lot of folks are on high alert this year more than most, given the magnitude of the macro backdrop. That being said, I think when I think about client conversations and activity within, we'll call it the April paradigm, as all this came to light, it's really about understanding that risk management needs to be perpetually in place and not be reactive to forces that you can or cannot control when they happen in the moment. And so, for folks that have been, long-term clients of us, it was really, evaluating how to either monetize the opportunity from an opportunistic perspective or to stay the course, given programs that we had in place. So, we try to take advantage of volatility when it arises, but we're of the position that it'll always be there. You just can't time when it is. And, we've had that V-shaped recovery, which has happened, I'll call it a fair amount of times the last decade, really, and that clients, while they've been fortunate to have that V-shaped recovery, shouldn't always plan on it.
Mm-hmm. And Kevin, how have the first two quarters played out from the lens of NASDAQ index options? What type of behaviors are on display?
So first of all, I like the way Eric framed that control element and the volatility that just is and will be in the future. And I think that kind of flows nicely into the fact that index option and derivative conversations generally are going to coalesce around that idea of volatility because it's the common denominator. So just putting a couple of numbers around this, if you annualize NASDAQ 100 volatility year to date, it's running slightly below 31%. Now, a longer term average there is closer to 22%. So to Eric's point, we have had a fairly volatile first two quarters. From a historical perspective, like those vacillations are running just below the levels from 2022, which is a very difficult year, and 2020, which had it both ways. Now, price standpoint, Eric pointed it out in the S&Ps. The NASDAQ 100 is now up nearly 4%, slightly outpacing the S&Ps yet again. But if you look under the hood, we've had a rotation in leadership relative to what we saw, let's say, last year where NVIDIA dominated. So this year, Palantir, which was just added last year after they moved their listing, is atop the NASDAQ 100 performance list. The other kind of names atop that, Micron, Mercado Libre, CrowdStrike, and Netflix. Of the 101 holdings, there's two for Alphabet, 58 are higher year to date. Now, previous leaders have become drags, or at least in a couple of places this year. So I'm talking about companies like Apple and Tesla. Those are both down more than 20% year to date. From an NDX options perspective, the values remain strong. Big picture, there's been incremental growth after 2 consecutive years of really significant jumps in volumes. We tend to see slight declines when realized vol rips higher, like Eric was talking about the April paradigm. But this month, with a more normal volatility backdrop, is setting up to be the highest ADV yet for the product, which is wonderful. When we think about the behavioral points, industry-wide, and I imagine even Eric has seen this, the interest in short-dated maturities continues. It's arguably more pronounced in the Nasdaq 100. And what we've also seen is greater interest on the totally opposite end of the spectrum, where you're looking out 2, 3, or 4 years for optionality. That's coming from, in part, the asset management community that wants exposure to an index like this, and also the insurance world. Their goals often run parallel. People are increasingly clamoring for equity exposure that points to the Nasdaq 100, but they want some guardrails in place. That's a trend that I think will only pick up speed in the future and likely feed more business to Eric's firm.
Yeah. And Eric, it's interesting. You made a great point before that risk management isn't something that you set and forget, as the factors that influence the market are dynamic, right? So when you think about single stock, ETF, index options, and how the overlay strategies you pick for clients, do you recommend one over the other, or is it specific to client goals?
Yeah, I think there's a few kind of decision-making frameworks there. So one is, obviously the client objective is going to drive the bus on the decisions, but thinking about things from an opportunity lens, single names versus indices have a different, I'll call it risk reward, and the relationship there is visible. Apple can be up, Microsoft can be down, the Nasdaq can be flat. And so you get what's called a dispersion or a correlation notion to evaluate. But again, it's a function of the client portfolios and what their objectives are. And the other component to this, and where a lot of our institutional clients are coming to us, is evaluating their core book as it sits today. Why that book exists is largely fundamental bottoms-up stock picking through the years. And so they want to maintain those holdings for alpha reasons. And so hedging at the index level, but also maintaining their current positions so that those security selection, performance really can drive the bus for their alpha streams. And so it's client by client. But the relationship between individual securities and ETF of an index or the index itself is predicated on that opportunity set between the single names and the index. But also for some, non-institutional but taxable investors, it really has to evaluate the tax equation, given their basis, given their tax rates, or what the taxpayer ID is evaluating, but also whether or not, you can de-risk portfolio risk without having a tax implication.
Yeah. Kevin, what theme that's been consistent since you and I have been meeting on the subject is the growth that Nasdaq 100 index options have enjoyed. So when you speak to individual investors about options, how has their behavior changed over the past handful of years?
That's a fun question. You're right that we keep coming back to it. And this is kind of a role I've generally been in for the better part of a decade. And I would say that the evolution with regard to understanding and acceptance of options has been totally amazing. I wish I could take credit, but like Eric mentioned a little bit earlier, big shifts are never attributable to just one thing. But I do think back to people like Eric coming to exchanges in 2016 or 2017, and he would point out how investors want optionality, but they didn't necessarily want to manage it themselves. And in many circumstances, it turned out he was very right. And I think the growth of companies like SpiderRock Advisors is a testament to that side of the demand equation. But there's also been a huge increase in the number of investors that do want to manage and understand their exposures themselves. They've been introduced to these markets through retail brokerage firms, through social media. And hopefully there is educational materials available to them. That is often the case on the brokerage side. And there's content being created to meet those investors where they're at. That's been a huge driver. And as you know, and the audience likely knows, individual investors now make up a far larger proportion of both cash equity and option markets than they did like a decade ago. The demographic of those who understand these markets skews much younger, far less male, and I think that's a giant leap forward for our industry. So the changes at a high level have been dramatic, much of it in just the past handful of years. And now I would argue that those changes are going global, which is super exciting.
Yeah. Eric, as Kevin had mentioned, you've been advocating for optionality and its benefits for years. Given the growth, the availability of wrapped product, and the broader understanding, how or where does a firm like yours continue to expand?
Sure. It first starts with choice and creating parity between the choice and understanding those costs and benefits between what I'll call the wrapper selection, but also the strategy. Certain strategies aren't permissible. I shouldn't say permissible, but feasible, either operationally or as a fiduciary in certain wrappers. And so it's really around understanding why folks are choosing either the strategy or the wrapper. And so a lot of our work with clients is around business practice management and their operational scalability. So imagine you're managing money for two people. That can be solved with X and Y. And imagine if you're trying to solve that for 2,000. The answer changes based upon how many individual folks you're trying to manage money for and whether or not it's centralized. That's what we call model-based portfolio construction. And then at the end of the day, I think the biggest notion here and the trend the last decade has been this notion around looking at pre-tax returns, but more importantly, the after-tax implication or the after-tax returns. And so customizing these solutions and electing the wrapper, you need the menu of choice to create that cost benefit analysis accordingly. But really it's around understanding, the goal of portfolio construction, one, the business and the practice management of an advisor, two, and then the tax ramifications once those decisions are made, really as fiduciaries to the end client.
And Kevin, I want to ask you a similar question. As we mentioned, index options have boomed in recent years. Where do you see the next leg of growth for products like the Nasdaq 100 index options, the NDX and XND?
That really gets to kind of the heart of the matter for the business team that I'm a part of. From my perspective, I think the tailwinds for the Nasdaq 100 generally are massive, and that expands beyond like the derivatives team that I'm part of. And I sincerely believe that it could become more of a default index for the next generation. Before we went live today, I was talking to Eric. We both have 10-year-old sons, and I know that because they played baseball against each other earlier this week. And I think no matter what they pursue in life, I think that generation is going to have a natural affinity for the construction of the NASDAQ 100. I think the index has matured dramatically over the time frame that Eric and I have been in this business. And I say that with respect to things like volatility, turnover within the index, growth writ large, and the constituent balance sheets. And I think that transformation is reflected in a really, really significant outperformance in price terms. Now, that could certainly change in the future, but the implications could be very widespread. And I think that the more assets flow into products that are designed to track the index, the better. I think of that as the top of the funnel because it irrigates kind of the whole ecosystem, whether that's separately managed accounts that Eric's looking after, whether it flows into wrapped product. This money will find its risk managed. And I think that people value nonlinear outcomes. So to be a little bit more concise, I think the growth will come from flows that are both foreign and domestic. It's going to come from the maturation of and growing awareness of our markets. It's going to come from both active and passive. And I would argue that it's been kind of just a sprinkler so far for the NDX. And before long, we could have more like a fire hose. And I'm grateful for chances like this to come on and highlight that growth, Jill. So thank you.
All right. And we are grateful for both of your expertise. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.